How you doing? Steve Brand here, your favorite mortgageguy.com. There are some big changes going on with the mortgage industry effective today. If you're looking to buy a home or if you're a real estate agent working with buyers, it's not just TRID, which is happening in a couple weeks on October 3rd, but there are some huge changes that are going on right now today, September 14th. If you want to learn about what I'm talking about, watch this video. A home buyer or refinance borrower, you probably aren't aware of this. If you're a real estate agent, you probably heard about TRID. TRID, it stands for TILA and RESPA integrated disclosures. So we're taking the truth in lending and the good faith estimate, we're putting it together in one form. This is announced in April of 2014. When it was announced, what happened was everyone got rolling on it. It was supposed to roll out earlier this summer. The government pushed it out till October 3rd, so that's happening in a few weeks. But really what it is the disclosures themselves. So what that means is the initial disclosures, which in a refinance, that's when someone makes a phone call, and in a purchase situation, that's when the subject property is defined. What that means is when an offer is accepted. So that documentation has to be very, very precise and identical to the document that's going to be signed at the closing table. There's also some major time constraints where the title company and or lender is defined as who's going to send out the document. It has to go out 3 days before closing. None of this 3 minutes or 3 hours before closing. So there's some major changes when it comes to that. And this document that was sent out, or the facts on this, if you go online, you'll see is 91 pages long. Now, this is what I think is more urgent. Changes to the way that loans are underwritten and pre-qualified go into effect today for a lot of loans. That document is 867 pages versus the 91 pages. Now, why do I think that that's more important, and why am I addressing the urgency, especially for real estate agents, to really understand this? Again, TRID is something that they've been working on for months. All the software companies, legal departments at small mortgage companies and big banks, everyone was pretty much ready to go, and it's going to affect the disclosures. And for the most part, they're ready to go right now. I believe that within 30 to 60 days of after implementation by October 3rd, everyone's going to have this down. Everyone's going to understand it. They're going to be good to go. And that's really done by the title companies and the lenders and the company themselves. This is what's more important. When it comes to your borrowers, people getting loans in right now, 867 pages is what the loan originator, the banker, they have to know the guideline changes that are going into effect today, September 14th, and how that affects giving someone an approval. Now, this can affect anyone with loans that may have any of these different types of things. And this isn't an all-inclusive list by any means. But number one, how gift funds are looked at for borrowers. Anytime that there's larger than normal earnest money or bank deposits, those are being looked at differently now than they were last week. Part-time employment is looked at differently. Joint fund accounts. So if someone has a bank account with a non-borrower, mom or fiance or something like that, that's differently now. Part-time employment. Like I mentioned, I believe frequent job changes, completely different. If someone's self-employed and they have declining income, guideline change. Got to make sure I understand that to be able to give someone a qualified pre-approval. If someone's using pension or 401k income as qualifying income, that's a guideline change right now. If someone, this is a good one, if someone has temporary income reduction, for example, maternity leave, that's looked at differently now than it was just last week. Federal tax liens are looked at very differently as well. So these are the questions that you have to ask yourself. Is the loan officer that is working with the borrowers that you're working with right now, do they have a severe case of OCD? What I mean by that is, have they been studying these rules? Do they understand the guideline changes? Secondly, are they the kind of loan officer who's just what would be called an originator, meaning that they go out and chase down the loans and then get all the documents and give them to their processor or a junior loan officer for them to vet income? Because they don't know how to vet self-employed income. Review Schedule C's for self-employment. Schedule E when someone has multiple properties. Review Schedule K1s. And what if someone's got unreimbursed business expenses? Is that going to affect their loan or not? Or thirdly, is the loan officer you're working with someone who just pulls credit, says, do you got a job, and then willy-nilly hands out pre-approval letters? This is an important time. changes are going on. If you have questions, let me know. Thanks.